Ethereum is currently trading between $2,800 and $3,000, a level that places it approximately 40% below its all-time high of just under $4,900 reached earlier this year. For many investors, this price action feels like a prolonged consolidation, perhaps even a bearish signal. But according to a comprehensive analysis of 12 established Ethereum valuation models, the picture looks very different, says Ki-Young Ju, the CEO of CryptoQuant. Out of those 12 models, 9 indicate that Ether is significantly undervalued today. When all 12 are combined into a single composite fair value estimate, the result is approximately $4,836 per ETH. That represents potential upside of more than 58% from the current spot price. The models themselves are not speculative creations. These models were built by trusted experts across academia and traditional finance, Ki-Young Ju emphasized. 8 of the 12 carry a reliability score of at least 2 out of 3. Some of the standout readings are particularly striking. The Metcalfe's Law model, which values a network proportionally to the square of its active users or nodes, currently implies a fair price of $9,484, meaning Ether would be undervalued by over 211%. The App Capital model, which incorporates the total value of all on-chain assets, stablecoins, ERC20 tokens, NFTs, real-world assets, and bridged tokens, arrives at $4,918. The Layer 2 TVL framework, focused on the explosive growth of Ethereum's scaling ecosystem, points to $4,633, or roughly 52% undervaluation. Yet there is one notable outlier, and it happens to be the model that Ethvolve's methodology ranks as the single most reliable, the revenue yield model. This approach values Ethereum based on its annual fee revenue divided by the staking yield. It currently concludes that ETH is overvalued by more than 57% and should trade closer to $1,300. The bearish signal reflects a harsh reality. Ethereum's base layer fee revenue has collapsed to multi-year lows as activity migrates to Layer 2 networks and competing Layer 1 chain continue to capture market share. This tension between network utility that is increasingly off-chain and revenue that remains stubbornly on-chain lies at the heart of the ongoing valuation debate inside the Ethereum community. Looking ahead, 2 developments could shift the balance. First, spot Ethereum ETFs have begun to see renewed institutional inflows after a painful $3 billion outflow phase that coincided with the drop below $3,000. Second, the Fusaka upgrade, scheduled for December 3rd, will increase gas limits, enable higher block throughput, and accelerate the rate at which ETH is burned, potentially returning the token to a deflationary supply dynamic. Early whales, however, continue to distribute. At least one ICO-era participant has realized gains exceeding 9,500 times their original investment in recent weeks. So where does this leave us? The majority of sophisticated valuation frameworks suggest that Ethereum is trading at a historic discount, while the single metric most tied to current fee generation screams overvaluation. History has shown that in transformative networks, user growth and total economic value often lead revenue recognition by years. Whether this disconnect resolves in favor of the bulls or the bears will likely define Ethereum's price action through 2026 and beyond. If you found this analysis useful, please consider leaving a like, sharing your thoughts in the comments, and subscribing for regular in-depth updates on macro and crypto markets. Thank you for watching, and I'll see you in the next one.